Picture this. October 29th, 1929. Manhattan, Lower Broadway. You're standing on the sidewalk outside the New York Stock Exchange, watching men in tailored suits stare at ticker tape like it's a death certificate. Prices are falling so fast the machines can't keep up. Shares that traded at 300 just weeks earlier are now changing hands for 30. Some don't trade at all. They just vanish. Inside nearby offices, margin clerks are calling in loans that can't be paid. In Chicago, wheat prices collapse. In Detroit, factories slow to a crawl. By the end of the week, over 16 million shares have been dumped into a market with no buyers. But here's the detail most people miss. The crash itself didn't destroy America. What came after did. Between 1929 and 1933, industrial production fell by nearly 47%. Bank deposits were wiped out. Over 9,000 banks failed. Unemployment hit roughly 25%. 1 in 4 men without work. And yet, this is the part no one tells you. Some people didn't just survive. They positioned themselves so well that the Depression became the foundation of generational wealth. Not by luck, not by optimism, by understanding 3 brutal lessons the crash exposed. Lessons that still work. Lessons that still repeat. Lessons that, if you ignore them going into 2026, will leave you standing in the modern equivalent of that 1929 crowd, watching paper wealth evaporate. This video is your 1929 survival manual. History doesn't repeat. It compounds. The mainstream story of the Great Depression is simple. Stocks collapsed. Banks failed. Everyone suffered equally. That story is comforting and wrong. The hidden truth is that the crash of 1929 didn't punish recklessness alone. It punished fragility, and it rewarded a very specific kind of financial positioning. By the end of this video, you'll understand the 3 lessons that actually survived the Great Depression. Not slogans, not cliches, mechanisms. You'll see why liquidity mattered more than returns, why debt quietly became a death sentence, and why control of productive assets outperformed every safe haven people talk about today. Most importantly, you'll understand how those exact mechanisms are quietly reforming right now, under different names, newer technologies, and far larger numbers. This isn't nostalgia. This is pattern recognition, and the pattern is setting up again. Quick pause. If this is already forcing you to rethink what safe actually means, subscribe. This channel doesn't sell optimism. It dissects history so you can see the traps before they close. Now let's start with the first lesson. Lesson 1. Liquidity beats intelligence every time. In 1929, the smartest investors in America still went broke. Not because they were wrong, but because they were illiquid. Margin debt peaked at roughly $8.5 billion in 1929. Adjusted for inflation, that's over $150 billion today. Investors weren't just buying stocks. They were borrowing to do it, often with as little as 10% down. When prices fell, brokers didn't care about long-term value. They demanded cash. Immediately. If you couldn't pay, your assets were sold at whatever price the market offered. Not fair value. Fire sale value. Here's the brutal math. If a stock falls 50% and you're levered 10 to 1, your equity is gone. Not damaged. Gone. This is why liquidity, not intelligence, determines survival. Those who held cash, short-term treasury bills, or unencumbered assets had optionality. They could wait. They could buy when prices collapsed. They could refuse bad deals. Yotpe. Morgan's syndicate famously stepped in during earlier panics by providing liquidity when no one else could. In the 1930s, private individuals who survived did the same thing quietly, buying farms, factories, and urban property at fractions of replacement cost. Meanwhile, brilliant analysts with perfect valuations were wiped out because they couldn't meet a margin call on Tuesday morning. Liquidity isn't about returns. It's about control under stress. And here's where this becomes uncomfortable. Today, liquidity looks abundant. Trillions slosh through markets daily. But it's conditional liquidity. Repo markets, margin credit, corporate buybacks funded by debt. When conditions tighten, liquidity disappears first, exactly like it did in 1929. The lesson isn't hold cash forever. The lesson is this. If you need constant market cooperation to survive, you're already fragile. Lesson 2. Debt turns volatility into fatality. The Great Depression wasn't just a collapse of prices. It was a collapse of balance sheets. By 1933, consumer prices had fallen nearly 25%. That sounds good until you realize what didn't fall. Debt. If you owed $10,000 in 1929, you still owed $10,000 in 1933. But your income was lower. Asset prices were lower. Liquidity was gone. Debt became heavier as the economy shrank. This is the deflationary trap no one wants to talk about today. When asset prices fall faster than liabilities, leverage becomes a weapon pointed inward. Farmers were crushed first. Falling crop prices meant revenue collapsed while mortgage payments stayed fixed. Foreclosures surged. Land changed hands not because it was worthless, but because debt made ownership impossible. Urban homeowners followed, then businesses, then banks. Every layer of leverage amplified the downturn. Now, compare that to the modern world. Global debt today exceeds $300 trillion. That's more than 3 times global GDP. Governments, corporations, households, everyone is levered. We've normalized it because low interest rates anesthetize the risk. But rates rising don't just increase payments. They change behavior. Debt removes flexibility. Debt forces timing. Debt converts market volatility into solvency risk. The survivors of the 1930s didn't avoid assets. They avoided obligations. That's the distinction most people miss. Lesson 3. Control of productive assets beats paper safety. Here's the counterintuitive truth. Gold didn't save everyone in the 1930s. Stocks didn't destroy everyone either. What mattered was ownership of productive, cash-generating assets without leverage. Factories that still produce goods. Farmland that still grew food. Rental housing that people still needed. Even during the worst years of the Depression, economic activity didn't stop. It repriced. Those who owned productive assets outright could operate at lower margins, wait out volatility, and benefit when demand returned. Those who owned paper claims, high-yield bonds, speculative equities, levered trusts, were dependent on systems that broke. This is why some industrial families expanded during the 1930s while passive investors were annihilated. They controlled inputs, production, and distribution. Control mattered more than yield. And this is where modern narratives get dangerous. Today, we're taught to chase passive exposure, index everything, outsource decision-making, trust liquidity. That works until it doesn't. In stress environments, control beats correlation. Every time. Here's the brutal truth they won't tell you. The Great Depression wasn't an unpredictable accident. It was the mathematical outcome of leverage layered onto fragile liquidity structures. The same structure exists today, just scaled up and digitized. Central banks can delay consequences. They can't erase balance sheets. When volatility returns, it won't ask whether you believe the narrative. It will test your structure. Do you rely on continuous refinancing? Do you depend on rising asset prices to remain solvent? Do you hold assets you can't exit without moving the market? 1929 answers those questions mercilessly. Now, for the contemporary warning. You can already see the signs. Asset prices elevated relative to incomes. Corporate debt issued at record levels. Consumers stretched by variable rate obligations. Governments normalizing deficits as permanent policy. This isn't prophecy. It's pattern alignment. The next crisis won't look like 1929 on the surface. Different assets, different triggers, same mechanics. Liquidity will vanish where it's assumed permanent. Debt will amplify small shocks into system-wide failures. Control will matter more than diversification slogans. The winners won't be the loudest optimists. They'll be the quiet planners. So let's synthesize this into a 2026 playbook. 1. Preserve liquidity. Not to hide, but to move when others can't. 2. Reduce dependency on leverage. Flexibility is survival. 3. Prioritize control over yield. Own what produces. The pattern is old. The numbers are new. In 1929, people stood outside a bakery wondering how bread became unaffordable. In the next crisis, the assets will change, but the confusion won't. History already gave you the answers. The only question is whether you'll use them before the tape starts falling again. Thanks for watching. Subscribe if you want history without anesthesia.